Hello viewers, I'm Sanjeev Pandya welcoming you to the Tax Talk show right here on ITV Gold. And before we begin, I like to say thank you so very much for watching the show and for your feedback and questions. We do take questions. You will see the email ID on the screen, so do send your questions. And if you really have a serious question and if you want a private consultation, you can visit Science CPA Services. They've got multiple offices in the state of New Jersey. Visit their website, Science CPA Services, to get all the details. And their phone number is 908-380-6876 for any tax related matter, personal or corporate, doesn't really matter. Science CPA Services will help you out. And the reason I'm saying it, because in this Tax Talk show, the person who advises us, guides us and suggests us when it comes to tax matters is from Science CPA Services. I am Mr. AJ Kumar, CPA and MBA, and he's with us once again. Ajay ji, welcome to the show.
Thank you, Sanjeev ji.
All right. You know, Ajay ji, every week you bring so much information, so much to
pleasure.
share with our viewers. We really appreciate it.
Thank you. It's our pleasure.
And the viewers, you know, this is a show, Tax Talk show, where you get most of the information. Whatever that you need to know about taxes, this is where you will find out every week during the tax season. And happy to be with you. I like today's topic.
Absolutely.
And I am looking forward to.
I'm very excited about it
I'm
as
looking
well.
forward to get a lot of details from you about this topic. This is a very, very interesting topic. You know, we talked about W-2s and 1099s, but this topic, viewers, is about you know, there are wealthy taxpayers, and we've been hearing talk for so long that they don't pay enough taxes. Okay, wealthy taxpayers don't pay enough taxes. It's upper middle class, lower middle class basically pays taxes. But then wealthy taxpayers also get some kind of, you know, relief treatment from IRS. Not I'm saying that relief treatment in the sense that they're not bothered, but they are less bothered. And now IRS is coming out very stronger, bigger after these wealthy taxpayers. They're going to have a very strong eye. They're going to open their third eye, if I may say.
Absolutely.
They're going to open their third eye and look in between the lines and numbers. Let's talk about that. Why IRS is really going after high-end net worth individuals.
Absolutely. So you are 100% right. The general perception is the high net worth clients do not pay enough taxes. And take an example. If you have a W-2 job, $100,000, you would typically end up paying almost $20,000 in taxes. People who have $1 million coming in through various businesses, even if they are paying $100,000, 5 times more than what you are paying, their tax rate is only 10%. So the perception is that high net worth clients are not paying enough percentage. I mean, depending on who you are, how you look at it. If you ask the high net worth person, they'll say, I'm paying $100,000. What more do you want? But if you look at it from a percentage perspective, you will find people who have businesses, typically their tax percentage rate is lower than a typical W-2 person. And you wonder why? How?
Exactly.
So a typical W-2 person, before the person is paid, before the individual is paid, this information is reported to IRS. This information is reported to state. There is no room to hide anything. What you have on W-2 is what you must report on your tax return. Otherwise, you'll get a computer-generated automatic letter from IRS that you are not reporting your income right. So the room to hide anything is not there when you have a W-2 job. But when you have a business, when you have high net worth clients, and typically most high net worth clients are business owner.
Yes.
So the W-2 job for $1 million, $2 million, $5 million are not common. But it's common to see small business owners making $1 million, $2 million, $5 million. That's not very uncommon. So knowing that these high net worth clients are typically the business owners, that allows them certain deduction. The government allows certain deduction. It opens up the room for the gray area. It opens up the room to hide certain things, right or not? And that creates a perception that the high net worth clients, typically the business owners, are not paying enough taxes, are not paying their fair share of the taxes.
Absolutely, this is going to be interesting. Now, let's say, okay, so now we know these are high-end clients, and you know, they have a huge network and whatnot, and they make a lot of money, and then they try to save taxes. How do you define the income level? How do you define which one is a high-end net worth individual?
Well, it depends on the program to program. The program that we are talking about today, in that program, The high net worth client is defined by IRS as somebody who is making more than $400,000 on their tax return. It could be married filing joint, husband, wife making $200,000 each, or it could be just a single person or head of household making $400,000. So they don't look at an individual, they are looking at the tax return.
Yes.
And that the program is designed for the families, for the tax returns, where the income is more than $400,000, Sanjeevji.
$400,000. Anything above $400,000 is the high-end individual. Very nice. Now, what are they going to look into it? That if the taxpayer is reporting all the income on their tax return, is that what they're going to look for it, or they're going to look for the expenses that they have taken deduction of?
Well, both. So the current program that we are talking about today, where the IRS is giving $70 billion over the next 10 years to hire new staff, to train the current staff. And the focus is going to be only the high net worth client. The $70 billion is assigned to target, to see the high net worth clients are paying enough taxes. And IRS is expecting, Sanjeevji, to get $700 billion out of this project, 10 times more over the next 10 years. So this is supposed to be a very lucrative project for IRS.
It's a very profitable project for them, for government.
And not just that, it's not one time, it's not about
Yes.
collecting $700 billion, it's more about correcting the behavior. Once IRS audits so many high net worth clients, a lot of these people will start paying their fair taxes.
Yes.
A lot of people will learn from these people. So in general, the tax system will improve, and IRS Treasury will start collecting more taxes than what they're collecting now. So coming back to your question, the income or the expense, Sanjeevji, so most income is directly reported to IRS. When you have a 1099, when you have a W-2, when you have a miscellaneous income, when you have gambling income, when you have lottery income, all these type of incomes are directly reported to IRS and the state. So it's very hard for anybody, business owner or no business owner, to hide the income portion. A lot of gray area creeps up when it comes to the expenses. The income section, even the credit card transactions now. So if you have a grocery store and you have a lot of credit card transactions coming in, all these transactions are also reported to IRS. If you have any transaction of more than $10,000 in cash, that gets reported to
Yes,
Treasury as
very
a
true.
CTR is filed. So unless you're talking about a small cash income here and there, other than that, a lot of income transactions are already taken care by the IRS, by the state. They are automatically reported. If you miss any income, the computer system will automatically generate a message, generate a notice that you missed this income and this is what you owe. They will compute an automatic tax liability that this is what you owe and please pay this bill. Most of the gray area, most of the cheating happens on the expense side.
Yes.
Can you really claim this expense? For example, you have a small business, you're doing the MBA, or your son is going to school and you try to push the tuition fees as a business expense. The son has nothing to do with your business. He's not working for you. Even if he was working for you, does it really make sense for your small business to pay an independent employee?
Which accountant would allow that to do?
Well, a lot of these taxes are done by themselves. A lot of these taxes are done by the business owners themselves, or in a lot of cases, the accountant is not doing the financials. So when you see the accountant doing the taxes, in those cases what happens, the business owner comes, here is my P&L, profit and loss statement.
Yes.
I got $1 million coming in and these are my expenses.
And they'll just take their numbers and then
And
do
the
the tax return.
accountant is not reviewing these numbers.
Yes.
They're not on the hook. They're not
Yes.
being paid to review the numbers or checking if the numbers
Correct.
are right or not. The assignment in those cases, Sanjeevji, is simply, merely, these are the numbers, I'm responsible for it, please file my taxes.
So that means that individual, that high-end individual, does not want to pay accountant their fees and everything, or wants to save on their fees, but at the same time want to take all the deductions that you cannot even think about that.
You are 100% right. And a lot of these, it's not about the CPA fees. A lot of these small business owners really know that this is not right.
Yes.
They already know what they're giving is not right. If they ask the accountant to review the books, the accountant will not allow these expenses. They cannot sign their name off. So when we get these kind of cases, we'll ask the client to say, please write that these are my financials. If I get audited, I'll be responsible for it. So if you want me to be responsible for it, I'll have to review the financials. Otherwise, I'm only responsible for the tax side of it. That I guarantee that the tax return is done right. And if there is a notice, I'll be happy to support you.
So IRS auditor is going to separate tax returns. I guess, let's say if they are spending $70 billion and if they're going to have a big team going after high-end net worth, first thing they're going to do is look at the tax return and they're going to start separating which one is prepared by accountant, signed by an accountant, and which one is not signed by an accountant, only signed by the taxpayers.
That's an easy criteria. You are right.
Correct. And target those first, because chances are that there will be a lot of hidden gems that you will be finding out.
Well, you're 100% right. That's one criteria, but IRS will never accept it because legally you are not allowed to differentiate between a professional versus a non-professional.
Yes, I know that. I know.
But the other thing you want to consider, all these audits are typically triggered by the computer first. See, there are 200 million taxes that are filed.
But who makes a computer program?
Absolutely, absolutely. So when the IRS auditor is looking at the tax return and they see this tax was prepared by the client himself or herself, they are scrutinizing it more because they know there may be technical problems, there may be technical issues with the tax return, as opposed to when a tax return is prepared by a CPA or a competent accountant who is registered with the IRS. In that case, the system is not expecting at least the technical problem. There are certain expenses that may still not be allowed, and IRS audit happens all the time because a lot of these financials are prepared by the business owners themselves, and that's when the audit is triggered.
I'm thinking of a line of the song that I've got an eye on you. That's the line that I'm thinking, because I'm relating that line to the topic here, because IRS really got an eye on the wealthy taxpayers, high-end individuals. Now, earlier you mentioned if anyone making $400,000 a year, that's considered high-end individual. Okay, fine. Now my question to you is that why people who are making less money than $400,000 are audited more than...
Well, there are more people who are making less than 400,000 than the people who are making more than 400,000. So if 100 people are getting audited who are making more than 400,000, there are probably 500 people
are getting
who are
audited.
making less than 400,000. But if you look at it from a percentage perspective, people who are making $400,000 or more are getting more audited in terms of percentage. So there are these many people, and let's say 7% people are getting audited who are making more than $400,000, as opposed to only 0.5% people who are getting audited, people who are making less than $400,000. So from a percentage perspective, the audit happens more for the high net worth client as opposed to the low net worth client. For the low net worth clients, typically the audit happens because you did not claim your income. There was a W-2, there was a 1099, there was an interest, there was a dividend, there was a small income that you did not remember, that you forgot to include, and that triggers an automatic audit. The other thing could be the rental property. A lot of rental income is considered as passive income. After claiming the depreciation, the losses should not offset your active income. That's the main reason when you have a rental property and you're not making any money and you're still being audited, because somebody tried to claim the rental losses as the active losses, or you forgot some stocks. You sold some stocks and you did not get the 1099 from the company, and you completely forgot about it, and IRS got a copy. And now the file that you submitted, the tax return that you submitted is not matching with what IRS has, and that's triggering the audit.
That's where this famous line comes in. I forgot about it, right? Oh, I completely forgot about it. I didn't know that this was a...
It happens.
This is a very popular line among the taxpayers.
Absolutely.
Who wants to really save money on the taxes. All right, moving on to this. Now, high-end taxpayers, 400,000 plus, obviously they've got reasons also to show expenses.
Absolutely.
Rental losses, hobby losses, any kind of hobbies and everything, how do they work on their tax returns?
Well, if you have a W-2 job, then forget about this completely. The hobby losses, you don't claim anything. But especially when you have a business, then what happens, it becomes a gray area. Say, I'm trying to do something on the weekend, but is it helping my business or not? It's sort of my decision. I try to define it the way it helps me on my taxes. But in general, hobby losses are allowed till the extent of hobby income. If you are sort of teaching badminton to the kids and you had to buy a lot of badmintons, a lot of bowls, and you had to pay some sort of fee for the court. Are you making any income out of it? If you are making any income, your expenses are allowed to the extent of the income you are making. Otherwise, it's a hobby. It's not a sustainable business. So there has to be an intent to make profit. The way the IRS looks at it, you don't have to be making profit in your business. There are businesses, active businesses, that makes losses for several years before they becomes profitable.
Exactly.
Right? But the IRS is going to ask, is there an intent? Do you have a website? Are you advertising this business? How many clients you are getting? How many leads you are getting? How much time you are spending? There has to be an intent to make profit. If you have an intent, then it's an active business. If you are doing it on the side, on the weekend, then the IRS looks at it as a hobby. If it's a hobby, the losses are not allowed, only allowed to the extent of the hobby income.
Interesting. Cash incentive business. If there is a cash incentive business, you know that there are a lot of loopholes.
Absolutely.
Not to report cash and also save money on our taxes. Are they going to be targeted in this?
You're 100% right. So what happens if you have an IT consulting company as opposed to a grocery store?
Yes.
So the type of transaction we as an auditor expect in an IT consulting company are not supposed to be cash transaction. Everything comes via ACH or via check, and everything goes officially from the bank account. So the room to hide anything in terms of expenses is not there. When you have a grocery store, a lot of people are paying you in cash. When you have a laundromat, you are collecting a lot of cash. So IRS does not get a report when you are collecting this much cash. So the cash intensive businesses, just because they have more room to hide, are scrutinized more. IRS have special auditors trained to see, well, if you have a grocery store, they say, what's the zip code? Oh, this is New Jersey. This is the zip code over there. What are the other grocery stores collecting and reporting on their tax return in terms of cash? Based on those criteria, based on those statistics, IRS is selecting who to audit. A lot of small businesses are audited because they did not report any cash. How can you have no cash coming in your grocery store? For crying out loud, add the 12 months bank statements and add some cash onto it before you file your taxes. A lot of small business owners do not show any cash deposits in their bank.
Absolutely.
So how is that possible that you have a cash intensive business and no cash is going to the bank?
It's in the shoebox under their bed. That's right.
And that's how the IRS decide who to audit.
Correct. All right. So now, since we started now this business point of view, I really want to bring in this question, but I want to let viewers know that the topic today is in our Tax Talk show is that how IRS is going very strong after the high-end individuals, and it's a reported announcement that they have made. They're going to spend about $70 billion. This is going to be, I guess, multiple years, right?
Over 10 years.
Over 10 years, and they hope to recover. They hope to recover 10 times more.
$700 billion.
So, there you go. Billion. As we're talking B as in billion.
Yep.
All right. Now, my question to you is that high-end individuals, personal tax returns, we talked about it. What about corporate tax returns? Are they going to go after corporate tax returns? Who makes more than $1 million a profit?
Absolutely. In a corporation, there is a different division. Mostly for the C corporation is the only corporation that's not flow through. S Corp, LLC, their profit flows through to the individual anyway. So the same team can look at the individual tax return. So if the S corporation or the LLC are making more than $400,000, the S corporation or the LLC is not paying taxes. Those profits gets included with the individual taxes. And we have the episode in our next week section to discuss more about the business, the flow through business, and the pros and cons of each type of entity. But when it comes to the corporation paying taxes, we are typically referring the C corporation. In a C corporation, typically the IRS auditor focuses on the dividend. The money that's being taken out by the shareholder, is that being reported properly or not? Are the shareholders paying taxes on that money or not? But C corporation, the audit division is a completely different division than the high net worth targeted division that the IRS has.
So they're going to be targeted also.
Absolutely.
And I'm sure that they can find a lot of dough in those corporate tax returns.
Well, high income results into high scrutiny, results into high potentially result into collecting some money for IRS. It's a business for IRS.
Based upon your experience, since you've been in this field for over 20 plus years, based upon your experience, when was the last time IRS was this aggressive after high-end individuals, whether it's a corporate or personal?
Well, it happens every so often. Every few years, every 10 years, there is a new program. I mean, if you look at the history for the last 2 years, under the COVID situation, the Treasury has given out so much money in terms of EIDL, in terms of PPP, in terms of various grants. So Treasury has really pushed a lot of money into the system. Somebody has to pay for this money. The government has to balance the budget somehow. Who is to target? The best way you do is who has the money, high net worth clients. And not only you're collecting the money, you're correcting the behavior, you're correcting the perception, and look at it from a political perspective. It becomes a win-win for them because most population is making less than 400,000 anyway. So you are pleasing the mass, collecting the money, correcting the behavior for the high net worth client. So it becomes win-win-win, and it becomes a good investment. That
correcting a behavior thing has been going on for so many years, and people are still taking disadvantage.
You're 100% right, because the scrutiny is not as much.
Yes.
Or from IRS perspective, the scrutiny needs to be more. There are a lot of people who are able to still get through the under the radar, claim the expenses, not being caught. But when IRS catches somebody, they make sure that it becomes sort of an example. So they don't do it, and anybody who hears their story, they don't do it either.
The other question, as we're at the end of the show almost, and we have covered basically all the information on this topic. Do you think US is more tax friendly or tax audit friendly country in the world?
Well, when we talk about the US, the first thing that comes in mind, we try to compare, at least in our mind, with India, because we have seen that system only. So in US, more people file taxes just because everything is connected via social security number than in India. In India, we don't have a unique identifier number.
True.
So very few, especially when it comes to businesses, are filing the taxes their fair share.
Well, now it has changed.
It's changing.
Yes.
It's changing now. In US, more people file taxes from a percentage perspective, more businesses file taxes, a lot of loans, a lot of scrutiny happens through the tax return. More tax payments you are making,
Right.
better your lending capacity. So, but the system in general is a trust-based system. We don't really scrutinize when you're filing the taxes. IRS gets 6 years after you file the taxes to review your taxes, up to 6 years. So when you're filing the taxes, you claim certain expenses, you claim certain refund, and IRS typically will give you that refund, right or not. Then IRS has certain time frame to see if the refund was right or not, and they have the right to request that refund back or put a penalty if they feel the refund was not right.
Interesting. Very well. I guess with that note, we come to the end of this week's Tax Talk show. What an interesting conversation. IRS is going big, and they're going to have a very, very strong third eye on this high-end individuals, taxpayers, whether a corporation or individual, and that's the information we have gotten. Once again, any tax-related question that you have, you can contact Science CPA Services. 908-380-6876 is their phone number. Science CPA Services is their website, and Mr. AJ Kumar, along with other CPAs at Science CPA Services, will definitely help you out. AJ Kumar, thank you so very much.
My
once
pleasure.
Again.
Thank you for having me.
When we meet again next week, same place, same time, we'll have another interesting topic. But should you have any suggestions or comments, please send an email to the email ID that you will see it on the screen. I am Sanjeev Pandya, wishing you all happy and tax-free days ahead. So long.